Which slide? Last class. Any of you? We stopped at which slide? Which example that we stopped last time? Any of you there? 76. So we stopped. Thank you, Paul. 76. We stop at 76. 76. 76. The statement, isn't it? Okay. So 76. Huh? Okay. 76. 76. 76. 76. Okay, done about this one. Okay. Okay, 76. 76 here is the statement only. Okay. So we have to look at that one. Okay, so we look at this time is gain. Gain on this process. Okay, so these examples, if you refer to these examples, is relate with disposal. So for you can't see, so okay, sorry. I haven't shared yet. Sure. Okay, so this is what we have. Okay, examples here. Can see now? Is it okay now? Now we can see, isn't it? The slide that you have here. Okay, thank you, Lee. Okay, so for this disposal, we have 4 things that we need to look up for the disposals here. Okay, for the disposals, the one that you have here is you dispose. Okay, where is my pen? Okay, you dispose and then 100% dispose means that there is no subsidiary. Okay, no more subsidiary, don't need to prepare a consolidated financial statement. Okay, and then the other one you dispose, but you still have a control. So this one is no gain or loss going to be recognized. Okay, we're going to record as a movement in equity. Movement in equity. Normally when you sell shares or when you dispose of shares here, you're going to have a positive movement. But if you positive movement, you're going to credit your RE when you sold it, when you dispose. And then when the next one you have you still have a control. Let's say you have 80%, you dispose 10%, so you still have 70%, so you still have a control. The other one here you dispose, okay, you have 80% and then you dispose 40% for example, so now you only have 40%, so this one you dispose and this one become your associate. So associates here means that you don't have a control. Okay, the next one you're going to recognize here gain or loss here. Okay, and then the other ones you're going to dispose, okay, maybe 70%, so you're going to have 10% only. So this 10% here is considered as a simple investment. Okay, the situations that we have in example 3.6 or 3.5, 3.6. 3.6 here is a disposal, and then you're going to retain as an associate. Okay, for this example, you dispose and then retain for a associate. Okay, so when you dispose here, you need to calculate two things here. For the disposal, you're going to have 2 types of gain on disposal. The first one, you have gain on the remaining stake. Okay, remaining stake here, the one that you are still retain, you retain here. This one, you're going to have gain on remeasurement, gain on remeasurement. The second one is relate with the one that you dispose. So dispose here, you're going to have gain on disposal. But both of this gain is considered as a disposal gain, a gain on disposals. Okay, to calculate for the remaining stake here, you need to compare the cost investment and then we need to add the realizations of a post-acquisition reserve. Yes, so we need to add because we want to find why we need to add here because we want to find new CA, new CA because later on we're going to compare with the fair value. So the original cost of your investments here, so remaining stake here you have 30%. So 30 times with 14, so you're going to have 5250. Actually, if you don't want to calculate this one, you just look at in the balance sheet. There is a figures given here, 5250. The 5250 here is already given in the balance sheet. So just use that figure, slide 68. I can refer that one. Okay. And then this one is the original cost at the date when you acquired the control. But now the cost of investment has been increased due to the realizations of post-acquisition reserve body from your RE and also from a currency profit. Yeah. So the RE brought forward here. Okay, RE brought forward and the current year profit had been increased. Yeah? Now we're going to have here at these two, okay, RE brought forward that you realize and also the current year profit that we realize. Yeah? Altogether you need to add here. So you're going to have here 492 and 441. 492 and 441. 492 here is for the RE and then 441 here is for the current share profit. So you're going to have a carrying amount at a disposal date. Okay, this is the carrying amount at the acquisition date. So we need to find the carrying amount at the disposal date. So the amount here will be 6183 and then compare with the fair value. Fair value here is already given. Yeah? So it's given in the slide 66 already given. So you just compare the carrying amount and the fair value. So you're going to have a remeasurement gain of 192. This remeasurement gain here is for the remaining, the one that you remain in the company, yeah, remain, which is 30%, 30% that remains in the company. Okay, we have the first one, remeasurement gain. We already calculate this one. The second one, we need to calculate gain on disposal. So gain on disposal, the one that you dispose here is 50%. Yeah? Okay, so 50% gain on the disposal. Actually, this amount you can find from your income statements. Yes? Or you can compare here the sales proceed that we received and then minus with the cost of investment that disposed. This one is based on your calculation in slide 70. Yeah? So, or you can find this one from your income statement. But now we need to minus, yeah? Minus here post acquisition reserve here because we want to adjust the gain to the parents. Because the gain to the parents is different from the gains to the groups. Yeah? So we need to adjust for the post-acquisition reserve brought forward. But this time, the same thing here, but this time we time with 50% because we want to find the one that we dispose. Yeah? So the RE that we have here is 820 and then the current year profit is up to 9 months only, yeah, because you dispose on 30th of September. So time with 50%. So you're going to have here is altogether you're going to have 4820,735 here. So 820 going to have here 735. Okay, how much you have here? 820 plus 735. Okay, you're going to have here 155. Yeah? Okay, this is going to minus 6250 minus 155. Yeah, so you're going to have here the amount that you have here is 4695. So this 4695 is a gain on disposals and disposal. Okay, and then you need to add remeasurement gain 192. This one is from slide 71. Why we need to add here? Because we said that the remeasurement gain is also a parts of gain on disposal. The part of gain on disposal. So we need to add this one together. So it become 4887. Yes. So this is the total gain to the group. So total gain to the group, you have two elements, remeasurement gain. Okay, and then the other ones are gain on disposal. So we need to add together this one. Okay, now we prepare the journal entry. So the journal entry here is to record for the RE and also for the currency profit, the one that you make an adjustment. Okay, the first one is your RE here. So gain on the disposal of shares here is related with the 50% that we dispose. So you're going to have here 820. So 820 here is from the slide number 72. 72. Investment in associate is the one that remain 30% remain stake. So this one is slide 71. Yeah. So we're going to have 492 the portions of the RE. So you're going to have here RE brought forward. Okay, 1312. And then the other one is portion for a current year profit. So current year profit or the item that you have in the income statement need to portion with 9/12, yeah, for the periods that we have here. The taxation, also the NCI, and then you're going to have in turnover also. Okay, for the current year profit, the gain on disposal of shares here is like 72. You're going to have 735. Okay, and then the other one slide 71 here. You're going to have for one here is a shares of current year profit. Now you need to debit the investment in associate. Why you need to debit investment in associate here? Because when the company recognize a profit, they're going to increase the investment. So that's why you're going to debit a investment in associate for one. The same thing as this one, because the RE has been realized. So you're going to debit the investment in associate. Okay, and then for the NCI 294. Okay, turnover here 9 months, so 5/100. So this is what you have. Slide 72, slide 71. Yeah. Okay, so this is your journal entry number 1. This is journal entry number 2. Okay, the next one you're going to share for the profit for the next 3 months. Okay, for the next 3 months here. So the profit that we have here, now remaining stake that you have here is 30%, and then time with 3/12 for the next 3 months. There'll be investment, credit, shares in shares of profit in associate. And then the last journal entries here is to record for the investment in associate. To record for a remeasurement gain. But the term that we are using here is gain on disposal. But the amount here is referred to the remeasurement gain because we want to account for the remaining state. Remaining state that we have here is only a remeasurement gain. So we're going to recognize this one. But instead of putting it as a remeasurement gain here, we put it as a gain on disposals. So there be investments and then credit gain on disposals. Okay, now prepare the accounts here. If you look at here, so XY here will be 0 because no longer your subsidiary. And then you only look at the adjustments here. The adjustment here is only for 9 months. So this one is journal entry number 2. 820 here is a journal entry number 1. Okay, 735 is number 2. 192 here is journal entry number 4. Okay, shares in a profit of associate, journal entry number 3. This one is number 2. Number 2. This one is number 1. Yeah? So the figures here. Okay, return earning, ending or carry forward here will be 10,522. Okay, that is what you have for the statements of comprehensive income. So in a balance sheet, so XY will be 0. Okay, no longer subsidiaries here. Return of profit is the one that are carry forward. Investment in associates 5250 here is based on the new value of your investments. Okay, 5250. If you look at here, you have that one in your balance sheet. Balance sheet now we make an adjustment to this one. So adjustments that you have here, debit 492 here. 492 here is from the realizations of the RE, RE here, item listener entry number 1. 441 here is realizations of a currency of profit up to 9 months. Okay, journal entry number 2, up to 9 months only. And then the same thing here, currency of profit also. Current year profit for incomes here. Up, this one is up for 3 months. For 3 months. This is journal entry number 3. And then this one is a remeasurement gain, which is journal entry number 4. So you're going to have this one. Okay, done about this one. So we continue with your slide 77. Okay, so any questions that you have for this one? It's okay, isn't it? Okay. So we proceed, proceed with the next one. And illustrations 3.6b. But 3.6b is using, can I just close this one for a while? Okay, so this one is related with the method that we are using here is a net asset method. Okay, so we're going to have for the net asset method. So net asset method, MJ acquired 60% equity interest in OG on 30th of April 2016. Okay, 30th of April 2016. The purchase consideration was 70. Okay, COI 70. Net identifiable assets was 86. Okay, and then the NCI has a value of 28. So to up these two, you're going to have 98. So 98 for the investment and then minus net identifiable assets. So you're going to have a goodwill of 12. It's two bigger minus. Okay, on 1st of November 2017, MJ disposed of 40% interest in OG for a cash considerations of 50 million. Yeah? So you start with 60. Now you dispose 40, so you only have 20% of your remaining stake. This one is your disposal. OG identifiable net asset was 90 million and the NCI value was 34 million at the disposal date. At the disposal date. Net asset at the disposal date. Okay. The remaining equity interest has a fair value of 40 million. So this one is a 20% interest. The value here is 40 million. After the disposal, MJ has a significant influence. So means that it's become an associate. Any increase in the net asset since its position has been reported in profit or loss and the carrying value of the investment in OG have no change since acquisition. Goodwill has not been impair tested and no impairment have been impairment tested, but no impairments was required. Okay, so no entry have been made in the financial statement for this transaction other than for cash received. So this one we're going to use a net asset method. So for net asset method, previously we are using the cost method. So the important things here, just look at the profit for the year. And then you also have a comprehensive income. So we need to have two attributables to. One is for the profit, and then the other one attributables to is the others comprehensive income or comprehensive income. Okay, so two that you're going to have here. Okay, so we already calculate for the goodwills here. So this is how we're going to calculate for the goodwill. As MJ shows a controlling interest in a G, a gain on disposal, a gain or loss on disposal should be calculated. So we need to calculate the gain on loss on disposal. So additionally, the result of OG should only be considered in the segments of profit or loss, others comprehensive income for 6 months, starting from 6 months to 1st of November 2017. So we assume that the financial year end for this company is on 30th of April. So 30th of April, so you're going to account. So the last one is 30th of April 2017. So you're going to have start from May, June, July, August. Okay, May, June, July, August plus September plus October. So you're going to have 1, 2, 3, 4, 5, 6. So we're going to have 6 months. 6 months for before the disposals. Before disposal. Okay, therefore after 1st of November, starting from 1st of November here, we're going to account using the equity method because now you only have 20%. It become an associate. Okay. So this is what you have. Okay, so how we're going to calculate for the gain or loss here? Now we are going to use a net asset method. So net asset method, please refer to slide 37. Okay, can you refer back to slide 37? Okay, slide 37 to calculate using a net asset method. So we're going to look at the fair value consideration received. Okay, how much that you receive from the disposal? You receive 40, and then the other one is fair value of residual interest, the one that you have for that 20%. Okay, this one is for the one that you dispose. How many percent that you dispose? 40%. Yeah? Okay, fair value of remaining stake. So you have 40 million given. Value of the NCI going to have here is 34. So altogether you're going to have 124 minus net asset. So net asset including the goodwill. So net asset 90, goodwill 12. So you're going to have gain on disposals here will be 22. So this one is going to be recognized in the P&L. Okay, the shares of profit of the associate should be 20% of half year profit. So the profit, current year profit here going to have here is 15 million. So 15 million divided by 2 because we're going to account here from 30th of April until 1st of November only. So you're going to have 6 months. So 6 months here, you need to divide by 2. So you're going to have 7.5. So from that 7.5, your shares here is only 20%. So you're going to have here is 1.5 million. Okay, if you have a questions, because I maybe missed some of the thing that you have in the chat box, you can ask that one, yeah? Okay, so we're going to proceed with this one. So we're going to have 1.5. Okay, so for the consolidated profit or loss and comprehensive income, we're going to add across, but only for 6 months only. So you're going to add all the information here in the income and in the others profit or loss and others comprehensive income. You're going to add, but you need to portion the amount here with a 6 month because you're going to calculate from 1st of May until September only. After September, you don't have a control over the company. Yeah? Okay, and then you're going to have a shares of profit of 1.5 million. So 1.5 million shares of profit is shares from the current year profit. Yeah? Current year profit here, you're going to have 1.5 million. And then to add gain on disposal of share of 22 million, you can just add into the others income or show separately. So in the income statement, you're going to have your others income. Okay, in others income, you're going to have gain on disposals of 22 million. NCI profit for the years here is 40% time with 15 million time with 6 over 12 here up to May, from May 1st of May until 30th of September. 30th of September. 1st of May until 30th of September. So going to have that one. 30th of September. 1st of May until 1st of November. November. Okay, 6 months only. Okay, NCI in total comprehensive income also 40% time with 50 million. Okay, remember that your current year profit you have 50 millions. Comprehensive income also 50 million. So for the NCI, both of this one need to time with 6 over 12 and then time with 40%. Yeah, 6. So that one is for your income statement. And then for the statements of financial position, you're going to have here in your fixed asset or others non-current asset, you're going to have here investment in associate at the new value here, which is 40 million. Okay, no goodwill can become near here because now from 60% you already become 20%. So you already de-recognize that goodwill because you don't have a control over that company. The NCI also zero because you are not a parent of that company. Yeah? So this is example using a net asset method. Okay. So I think that the cost method is easy. You are familiar with the cost method. So either one, based on the questions. Okay, most of the time we are using the cost methods. Okay, that one is safe. Okay, so we proceed with the next one. Okay, now we're going to dispose the share, but this time we're going to retain it as a simple investment. So simple investments here means that your shares here is less than 20%. Yeah? Share less than 20%. They become a simple investment. Okay, for example, you have 70, dispose another 60, so now you're going to have only 10%. Okay, in this situation, the parent will consolidate the financial statement until the effective dates of a disposal. Okay, as the disposal of share will change the status of subsidiary to become a simple investment. The adjustment of gain or loss or disposal need to be done in a current year profit or loss account. So the same thing that you have, like the one that you have in associate, you need to do the same thing. Okay, the remaining stake. Okay, the remaining stake should be remeasured to fair value. Okay, going to measure at fair value. Remeasurement gain going to be recognized and then include in the gain or loss on the disposal. Okay, remeasure gain are parts of gain or loss on disposal. After the effective dates of the disposal, the carrying amount of the remaining interest going to be account using cost method. So because your investment is lower than 20%, you cannot use the equity method. So the equity methods here is only applicable or applied to the associates only. So now there is no, this is not associate, this is only a simple investment. So simple investment, we're going to use a cost method. So, okay, we try to look at this example. So if you have any question, voice out. I need to close your chat box here. So okay, AB acquire 80% interest, same thing, cash consideration 14 million, net asset was 12 altogether. On 30th of September 2019, AB sold 70 million shares in XY. So 7 million shares in XY, so we're going to look at here, 7 divided by 10. How many percent of subsidiary that you are going to sell this one? So you're going to sell 70%, yeah? So now you have 80, and then you minus 70%, so now you only have 10%. Your 10% here is your remaining stake. Okay, remaining stake. For the cash considerations of 15.5 million, so you receive that one. The remaining interest was measured at fair value of 3 million. So this 10% was measured at 3 million. Yeah? Okay, so this is what we have. You sold 70%. Yeah? Okay, so focus on this one. Gain on the disposal. Later on, we're going to make the adjustment to this one. Profit for the years. Okay, and also the RE brought forward. Yeah? So this is the gain. And then RE and also the profit. Yeah? Okay, and then another thing that you need to focus here is about this one. So you say that if you look at here, the investment in AB here, in the AB here is before this AB is a parent in XY. So if you look at here now, the balance of the investment is only 1750. At the beginning, at the acquisition stage, you have investments of 14 million. Now the value of investment is only 175. Yeah, this one and when you have 80%. So this one when you have 10% here. So reducing in the CA here. The CA here will be 14, okay, minus 1754. So okay, what you have here? 14 minus 1754. 1225. So this one is the reducing in the CA. Okay. So this is one method. A shortcut method you calculate from the information that we have in the income segment, in the segments of financial positions. Okay, so you need to calculate the gain. So this is another method to calculate the cost of investment that is disposed. Okay, the disposal of shares in subsidiary 7/8 dispose here 7 million divided by 8. So yours here, your shares in subsidiary here is only 8 million, yes, because you have 80% shares only. So the one that you dispose here is 87.5%. But in terms of disposal in the subsidiaries here, in terms of subsidiary, 7 divided by 10, because this is in the subsidiary account. This is the subsidiary. So I'm going to have 70%. Yeah? So the COI that you dispose here, 40 million here is the COI. Time with the percentage that we dispose here is 12250. Like the one that we calculate previously, 14 million minus 1750. At the end, you're going to have the same amount, either one. Okay. This one is the simple one. You need to calculate this one. Yeah? Okay, so that is what you have. Okay, so the one that you dispose. Okay, on 1st of January until 30th of September 2019. So 9 months, up to 9 months, you only have you have 10%. During this time, you need to prepare a consolidated financial statement. But after 30th of September here, after 30th of September, now up to 3 months here, 3 months you only have 10%. So this 10% is considered as a simple investment, less than 40%, 20%. Okay, so that is what you have. So the same thing that we need to do here is to calculate both. When you have a disposal, we need to calculate both gain on remeasurement gain, and then the other one is a disposal gain. Remeasurement gain here is for the remaining stake. Okay, disposal is the one that you dispose. Okay, remaining stake you have here is 10%. The disposals here is 70%. Okay, so we calculate for a remaining stake first, 10%. Okay, cost of investments here is 1750 given, given, or you can calculate from here 1/8 times with 14, or else just refer to the balance sheets information. 1750, and then because you want to find the carrying amount, so once you want to find the carrying amount, so we need to, okay, we want to find the, sorry. Just close this one. Okay, want to find the new CA. So want to find the new CA. For the remaining, want to find the new CA. Okay, the new CA here is the cost at the cost at the acquisitions here. Okay, the new CA. The cost to find the new CA is a cost plus a post acquisition reserve. Realizations of post acquisition reserve. Okay, so realization of post-acquisition reserve, we have two items, which is your RE brought forward and also the currency profit. So RE brought forward here is 3640 minus 2 here is at the acquisition time with 10%. 10% here is your remaining stake, 10% here. So you're going to have 164. Currency of profit, okay, up to the dates of disposal, 9 months only, time of 10%. So you have 147. We're going to have 147 altogether. So you're going to have here is a 2064. This 2064 here is your new CA or the CA at a disposal date. Okay. So at the disposal date, it will be 62061. Compare with a fair value. The fair value here is given 3 million. So you're going to find here is a remeasurement gain here is 939. Remeasurement gain of 939. So we have done the first part. We have done for the remaining stake. The next one, we need to calculate for the gain on disposal of that 70%. Okay, so the sales proceed that we have here, this is what you have. Okay, the sales proceed is 15 and then minus cost of the investment 12250, or you can find this one from your profit or loss account. So you already have here 3250. So 3250 we need to minus. Okay, we need to do an adjustment because we want to find gain to groups. So we need to minus post acquisition reserve RE brought forward, but this time we need to time with 70%. Okay, previously we time with 10%, but this one the same figure, but this one time with 70, previous time with 10. So you're going to have 1148 that you have here, 1148. And then you're going to have a current year profit. Okay, shares of current year profit. Okay, 70%, 1029. If you total up this one, 1148 plus 1029. Okay, you're going to have 2177, 2177. Okay, when you compare with this one, okay, 3127 minus 3254, we're going to have 1073. 1073 here is gain on disposal. And then remember that your measurement gain is also a part of a gain on disposal. So you need to add this one, add together with this one. So you're going to have altogether gain to the group will be 2014. Okay. Is you okay with that one? Any questions that you have for this one? We proceed now. So altogether, the total gains to the group is we want to find the total gains to the group will be 2012. So we need to prepare the journal entries here. So the journal entry is to record for the both gain. Okay, the first one is related with the RE, realizations of the RE. Okay, First one that you have here, gain on disposal of shares. So gain on disposal of shares here is for that 70%, which is page slide number refer to slide 91. This one is slide 91. So investment in shares here is for that 30%, 10% remaining stake. Remaining stake. Which one? This one is from slide number 90. And then we're going to have RE brought forward. 1312. Okay, the next one is this is journal entry number 1. This is journal entry number 2. So journal entry number 2 here is to record from a current year profit. So the current year profit, all the amounts here need to portion with 9/12 for turnover, expand, taxation, and then NCI shares here. NCI here is 20%. Okay, so gain on disposal of shares 1029. Okay, 1029 here is the one that you have in slide 91. So slide 91 here is related with the 70% that you dispose. 147 here is slide 90. Slide 90 here for the 10% that remains. So altogether you have, for this one is to prepare a consolidated result for 9 months. Okay. So that is what you have for the second. The first one is realization of RE, returns earning, and then the second one is the current year profit. Okay, and then the third one, you're going to record for the remeasurement gain. Third one. Okay, so remeasurement gain will increase your, okay, this one is a remeasurement gain. You're going to increase your investment and then credit gain on disposal. We don't use a remeasurement gain, we're using the word gain on disposal. So using this term, 931. But you know this figure is from the remeasurements gain. Okay, that is what you have for journal entry number 3. Okay, then we're going to assume that we already prepared for the consolidation and other subsidiary are not shown. So this is what we have for the consolidated comprehensive income. So for XY here will be 0 here because now you only have 10%, no longer your subsidiary. So the figures here will be 0. Okay, the credit side that you have here, turnover here is 5. All the adjustment that you have here is up to 9 months only, up to 30 of September, up to that date only. So 5.1, so up together. And then this one is from journal entry number 2. This one is number 2. Gain on disposal 1148. Okay, this one 148 here is come from which journal entry? Number 1 or number 2? This one is a remeasurement gain. 1148 here is from your RE. And number 1. So 1029 here is from your current year profit. Okay, current year profit. Journal entry number 2. 931 is a remeasurement gain, which is a journal entry number 3. Then taxation is number 2. Okay, NCI here is 294, is also number 2. So from that profit, allocate to NCI 294, means that the parent will be 2738. RE brought forward 1312 here is journal entry number 1. So we're going to have here 6712. 6512. Okay, this is your RE carry forward. Okay. For the balance sheets here, so 0 here, look at here, the RE carry forward 9250 from the previous one. Okay, this is the one that you have. Investment in shares, okay, going to debit with 194, 164. 164 is come from your RE, RE, which is a journal entry number 1. Okay, and then the other one is 147 here. 147 here is a journal entry number 2 from a current year profit. 939 here is from a remeasurement. Okay, journal entry number 3. At the end, the value of your investments here will be 3 million. 3 million, which is this figure should equals to the fair values that is given. Fair value that is given here is 3 million. Make sure that when you do the adjustment, if you find the figure is different from the fair value given here, means that there's something wrong with your calculations here, with the gains that you recognize here. So be careful now with this one. This one going to give you just like a checklist here whether your calculations is correct or not. Okay, this one will be the as same, should be the same as the fair value given. See? Okay, so we have done with the disposals. Okay, for disposals we have uh anything. Okay, for disposal is 100% disposed, so you're going to recognize again on disposals. And then you're going to have a retain here. The other ones you retain still have a control, so this one is no gain or loss, but we're going to recognize a movement in equity. Movement in equity. Okay, normally for the disposal, you're going to have a positive movement. Okay, and then the second one, from control become an associate. You dispose more shares, and now you have a shares which is more than 20% but less than 50%. So for this one, you're going to account using equity method. So the other one, from control becomes simple investment. So you're going to account using a cost method. Okay, for these two types of disposal, we need to calculate two things. Okay, calculate two types of gain. The first one is a gain on remeasurement gain. The other one is a gain on disposal. Remeasurement gain here is the remaining stake. Okay, the disposal here is the one that you dispose. Okay, both of this game here going to be recognized as a gain on disposal. Okay, so this is what you have for a disposal. Okay, any questions that you have for this one? Okay, just look at your tutorials for chapter 3. You need to submit by next week. Yeah, we try to until we able to finish your chapter 3 because we have another part for chapter 3. Okay, another part. Hopefully that together with the exercise, I'm not sure, not exercise, examples. Okay, I'm not sure whether we're able to finish that one by this week. We try to finish that one so that you can submit your tutorial. If not, we're going to discuss again about your submissions of your tutorial for the next class. It depends on the next class, whether we're able to finish up to the example or not. Okay, any questions that you have here? Any of you have a questions? If there is no questions, any questions? I'm not alone here. Do you have a questions? If not, I'm going to stop sharing this one. We're going to move to the second parts of your notes. So we move to the next one. Is it okay? Okay. So second part, sir. So this one is done. So make sure that you're ready with the second parts of your notes. Okay, this one is another thing that is more complicated now. Okay, before this, in part 1, you learn about increase in the shareholding and dispose in the shareholdings. Okay, now we're going to look at the complex group structures. Okay, not from this slide. Supposed to be the first one. Yeah? Okay, so now we're going to look at the complex group structure. Before this, you only focus on the group structures or the parents. You only have a parent and then one subsidiary. So that one is a simple one, but now we're going to have a complex group structures here. Means that parents have more than one subsidiary. Okay, may have subsidiary 1, subsidiary 2, subsidiary 3. Okay, so we're going to look at a complex group structure. Means that more than one subsidiary. Okay, to understand the complex group structure, calculate the direct and indirect interest. So now we're going to have direct and indirect interest. Direct here, from here, parents going to have one subsidiary. So this is we call as a direct. Let's say parent have 80%. And then the other one, this one is a direct. And then the other one, this subsidiary also has another subsidiary. Maybe they have here 60% here. So even though parents do not have a shares in subsidiary 2, but we said that parent has indirect control in a subsidiary S through subsidiary 2 through subsidiary 1. How many percent? 80 times with 60%. So indirectly, parents have a control 88%. So how will they control here? Even though the share that I have here is only 48%, not more than 50%, said that there is no control. But parent can control subsidiary 2 through subsidiary 1. We control here through subsidiary 1. So this is what we call as a indirect interest. Okay, going to calculate the direct and indirect interest for group and NCI. Prepare a consolidated financial statement. For a complex group, we have two methods here, stage by stage method. Okay, when we have a complex group, we have two methods, stage by stage and one stage method. Okay, and then we also have a changes in ownership. Changes in ownership, maybe we increase the shares or we make a disposal, reduce the share through a disposal. Increase shareholding or disposal. That is what we have for the changes in the ownership when you have a complex group, more complicated. Part 2. Okay, and then the last part, we're going to look at the loss-making subsidiary. What happened when you have a subsidiary, parent have subsidiary, but the subsidiary have a loss. So what we need to do for this one? Okay. So we're going to look at for the group structure. So for a complex group structure, we have 4 types actually. We're going to have 4 types here. It's a multiple direct subsidiary. Later on, we're going to look at what is a multiple direct subsidiary. So you have parents, subsidiary 1, 1, 2, 3. This one is a simple. But we have more subsidiary, but this one is only a direct. And then you have another one is father, son, and grandson. So father, son, and then grandson, parent to subsidiary 1 to the son, and then subsidiary 2. So this one is a father, son, and grandson. Yeah. Okay, and then the mixed group. Mixed group is a connection appellation here. Okay, parents has a subsidiary 1, and then have a subsidiary 2, and then parents have a subsidiary 1 also have a control over subsidiary 2. This one is more complex, a connection appellation. And then the last one is cross-holding. Cross-holding is very complicated. We're not going to focus on this one. This one is more on the pyramid shareholdings. Very complicated about this one. So we only focus on these 3. Multiple direct subsidiary, father, son, and grandson. And then going to have connection appellations. Okay, so we're going to look at the first one. Okay, for the first one, you have a multiple direct subsidiary. Okay, multiple direct subsidiary is a parent's own share directly. Okay, this one is considered as a direct only. In more than one subsidiary, okay, and that is known as a multiple direct subsidiary. So this one is direct. Okay. For each acquisition or subsidiary, the cost of investment and NCI are compared with the fair value of identifiable asset to determine the goodwill. So for each of acquisition, so in these examples here, parent have 3 subsidiaries. So for each of this one, parents going to compare COI plus NCI and then compare with NIA to find a goodwill. So goodwill 1, so this one the same thing, you're going to have here goodwill 2. And then this one you're going to have a goodwill 3. So altogether it's depend on how many subsidiary that you have. Then you're going to have 3 different account for a goodwill. Okay. So you're going to determine a goodwill. So for previous examples here, we're going to have 3 goodwills. It depends on how many subsidiary that you have. Okay, the same consolidation adjustment technique applied for each of the subsidiary. We're going to prepare the same consolidated journal entry. And then for each of subsidiaries here, okay, means that we are going to have more journal entry this time. Goodwill, NCI, and post-acquisition reserve for of each individual's acquisition are then combined for presentation in the set consolidated financial statement. The goodwill, NCI, and post-acquisition reserve going to be combined together to prepare for a consolidated financial statement. Yeah? Okay. So this is another examples of a complex structures here. We have another type here, a father, son, and grandson. So father, sons, and grandsons here is the parent's company hold a controlling interest in a subsidiary, which in turn has a controlling interest in others' company. So this one, a parents here, A control B 60%. At the same time, B also has a control over C 75%. So indirectly, parent have a control over C by 45%. And they have a direct share of 45%, but we said that even though the share here is only 45%, but parent can control C through B. Okay, parents control C through B. Okay, so even though the share here is only 40%. So now if you look at here, the NCI in B here is 40% because parent have 60. So NCI in B here will be 40%. And then NCI in C here will be 25% because B now become a parent. B controls 75% in C. So another 20% here is to NCI. Okay. The parent NCI interest, how you're going to calculate the parent and NCI interest directly. Parents control B 60%, and then parents indirectly control C here through B 60 times with 75. So you're going to have 45%. Yeah, so this one indirectly. Okay, for the NCI directly in B, NCI have 40%. Okay, in C, NCI have 25%. Yeah? Indirectly, NCI has a through B, NCI has 40 times with 75. Yeah? 40 times with 75. So indirectly, NCI have another 30%. So altogether for NCI here is 55%. Parents here is 45% has a control over. Yeah, even though NCI here is 55%, but parents still control C here through B. Okay, because B is a parents to C. Yeah? Is it okay with this one? Yeah. So you just look at the structures only. Yeah? What structures? This one is a parents. Yeah? Parent, son, and grandson. Okay, if you have question, then maybe I missed the one that you have in the chat box. Okay, so the next one, we're going to look at the next one, the next example that we have here, but another one. In practice, if B is not wholly owned by A, two sets of account need to be prepared, not wholly owned. Let's say in this example, A control B here is only how many percent that A control B? Okay, control B here is 60%. Control B 60%. So means that it's not a wholly owned. Not wholly owned. So one that is not a wholly owned, they need to prepare two consolidated financial statement. The first consolidated financial statement here is between B and C. The second consolidated financial statement here between A and B. So we're going to prepare two sets of consolidated financial statement. One is between B and C, and then the other one is between A and B. Okay, but if BB is a wholly owned by A, so let's say A control B 100%. Sorry, 100% is control B 100%. So it said that wholly owned, and then B has a control over C. So in this case, so if the A have 100%, okay, 100% in B, okay, it's not need to present a consolidated financial statement. So B do not need to prepare a consolidated financial statement. We only have a one only. Going to prepare only one consolidated financial statement. B do not have to prepare, do not need to prepare for a consolidated financial statement. Okay. So only wholly owned parent will be exempted from presenting a consolidated financial statement. Okay. So you prepare only one consolidated financial statement. Okay, now we're going to look at what is indirect subsidiary. So indirect subsidiaries here is when the equity shares of entity are held by subsidiary or subsidiaries of a parent in such a way that is allow the group to control the entity and indirect subsidiary insofar as the owner of parent or concern is said to exist. We're going to have a control over the subsidiary. Okay, even though we have indirect control, so indirect control, yeah, we're going to have indirect subsidiary, even though you have an indirect subsidiary, but parent also have a control over that subsidiary. Yeah. The parent interest in the subsidiary is indirect through shares held by other subsidiaries in the group. So that is a indirect subsidiary. So this is a simple one. Parents have a shares in A and then A have a shares in B. So we're going to have here 80%, this one is 60%. So indirectly, parents can have a control 48%. Indirectly, parents have a control through A, through A. Okay, this is what I mean by indirect subsidiaries. So we become indirect subsidiary to parents through A. Okay. So try to look at this one. These examples here. Okay, parents. Okay, in subsidiary A, we look at the subsidiary A first. Parent have 80%. Okay, in subsidiary A, and then subsidiary A have 30% in C. Okay, in C, that have 30% in C. So if you look at here, through A, parents going to have 80 times with 30. So 80 times with 30, so you're going to have 24. Okay, we look at the next one. So for C, in C, through A, parents going to have 24. Okay, and then through B, parent have 60 here, and then B have a shares in C 30%. So 60 times with 30. Okay, so we're going to have 18. So through B, they're going to have another 18. So altogether, parents going to have 42% indirect interest. Indirect interest in C through A and B. Yeah, they have here. Okay. That is what you have here. Okay, for a NCI here, so if you look at here, in A, parent have 80%, so NCI have 20%. So NCI indirectly oversee, NCI have a 6% here is 20 times with 30. So 6% indirectly, NCI has 6%. And then for B here, for B, parents control 60%, so means that NCI has 40%. And then B have 30% in C, so 40 times with 30 here, you're going to have 12 here. So 12 here. So altogether, NCI indirectly, indirect, NCI going to have 6 plus 12. So indirectly, NCI going to have 18%. Yeah? Okay, so please, if you don't understand this one, this one because your examples here will based on this one, direct, indirect here. Okay, so going to look at here. This is the explanations how we derive to that figure. So directly, so this is the one that we already calculate here. We are A, we have 80 times 30. Through B, we're going to have 60 times 30. Altogether, we have 42. Okay, NCI in A direct 20, in B direct 40, and then in C have direct 40. Okay, and then the through B, through A 6%, through B 12%, altogether NCI have 48%. If you look at here, the total shares that parent have here is only 42% indirectly, but parents still can control C through B. Okay, they can control C through B. Okay, okay, so, okay, so you're going to look at this. Okay, C is deemed to be a subsidiary of P. Even though the P has an indirect interest, C is only 42%, but it can exercise about 60% voting power of C as a group via shares held by A and B. So A have 30% in C and B also have 30% in C. So altogether they have 60%. So even though P has an interest, is only 42% indirectly, but they can control C through A and B. Yeah? For consolidation, the effective 42% interest, indirect interest will be used as far as a member of the parents are concerned. For the consolidation, to prepare consolidation, then the entry, we're going to use a 40% interest in C. Yeah? In C. Okay. So, and the next one, we are going to look at the connecting appellations. For the connecting appellation, here is the parent company hold a controlling interest in the subsidiaries. Okay, they hold the controlling interest in the subsidiaries, and both a parent and subsidiary has an interest in others company. Both of parents and subsidiary have an interest in others company. Okay, look at this diagram. Yep. Okay, parents control A 80%, and then A control B 60%. Okay, parents control A 80%, and then A control B another 60%. So indirectly, parents going to have indirect parents going to have 48, yeah? 48. Okay. And then it said that parents, okay, this is what you have indirectly. Okay, and then parent also have a shares in B of 15%. So altogether, parents going to have 15 plus 48, so 63. 15 from direct, 48 from indirect. Yeah? So altogether, parents have a share in B here is 63%. So the B is also a direct subsidiary of A. Yeah? So B become a direct subsidiary of A. This is what we have. Parent and NCI interest in a subsidiary can calculate this one. Yeah? So 80% that you have in A. In B, parents have 15%. Indirectly, parents have another 48%. Yeah? So altogether 63%. Okay, for the NCI here, in A, NCI have 20%. Okay, and then in B, NCI has 25%. Where does 25% come from? Okay, A to B have 60%. Okay, B to B another 15%. So altogether 70%. So means that to the NCI here is another 25%. Okay. So indirectly, NCI has 20% time with 60%. Yeah? So in B, NCI 20 times 60, so another 12%. So altogether going to have 37%. So make sure that when you calculate, this one should be 100%. Yeah? It should be 100%. Okay, so this is what we have. Okay, this is another examples that we have here. Okay, so parents to A 60%. So, and then the NCI have another 40%. A to B 30%. Parents to direct interest here is 30%. Parent indirectly here, 60 times with 30. So you're going to have 18%. This 60 times with 30. So you're going to have 18%. So 18% is indirect plus direct 30%. So parent going to have 48, 40%. Okay, for NCI here, NCI have 40 here, 40, and then indirectly time with 30%. Indirect. This one will be indirect for NCI, become 12 here. Okay, and then in B, NCI has 40%. Where does 40% come from? Parents have 30%, and then A has another 30%. So altogether 60%. So portion for the NCI here will be 40%. Okay, that is what we have. So 48 here, And then make sure that when you total up, parents and NCI here should be 100%. P effective direct and indirect interest in B, even though the P effective direct and indirect here, direct and indirect interest B is only 48%. B is deemed as a subsidiary of P because the group as a whole can control 60% of the voting power in P. Where to get this group as a whole here? Parents have 30%, A has another 30%. So altogether 60%. As a group, they can control over B. Yeah. Okay. So this is what you have for connecting a population. Okay. Any questions that you have for this one? Make sure that you know how to calculate this one. It's very important to calculate this one. Okay, we try to look at the methods. So a consideration technique. Okay. We have many. Okay, so still have time, yeah? Okay, for consideration techniques for the indirect subsidiary where subgroups exist here. Okay, when you have a subgroup exist, okay, more than one set of group account must be prepared. Okay, when you have a subgroup, you need to prepare more than one set of account, yeah? When you have a subgroup, yeah? You need to prepare more than one, yeah? Sets of group account. If the immediate parent is not a wholly owned, it's not a wholly owned. So methods that we prepare for consideration here, we have stage by stage method. Okay, and then the other one is a one stage method. We're going to look at both. We have two methods to prepare consolidated financial statement, stage by stage or one stage methods. Okay. So we're going to look at for the first one, stage by stage method. For stage by stage methods here, the subgroup account at the lowest tier. Okay, we're going to start with the lowest tier. For example, we have B and A and then A and B. So this one is considered as the lowest. We're going to start with this one first. Once you prepare one consolidated financial statement, and then after that we prepare another consolidated financial statement. Start with the lowest tier. Lowest tier going to be prepared first. The constellation is repeated by progressing stage by stage upward until it reaches the highest tier of the ultimate parents. So going to start with the lowest stage with a lowest tier, and then going to repeat the same process of the consolidation until we reach to the ultimate parent. So the ultimate parents here is this P. Yeah? Additional adjustment that we need to do here, if the NCI is measured at the proportion of net asset at each subsequent level, goodwill to indirect NCI is excluded. We need to exclude the goodwill to the indirect NCI if you are measure NCI using a proportionate share by debiting NCI account in the statements of financial position. We need to exclude the goodwill for indirect NCI. Maybe you don't understand this one yet. We're going to look at the example for this one. Yeah. Okay, we try to look at these examples. For example one, father, son, and grandson structures. Okay. Okay, A acquired 60% interest in the equity capital of BB on 31st December 2018 when the net asset was 3 million. So the net asset here is 3 million. On the same day, BB acquired 70% interest in the equity capital of CC, and then the net assets was 2.5. Yeah, so A acquired 60% interest in B. B net asset was 3 million. And then after that, B acquired C. The net assets was 2.5 million. So 75% here. This one is 60%. So this is a financial position for the three companies. Okay, so this is the investments in B, 3 million. This is investment in C that is paid by B. And then this is the assets that you have here. Okay, at the respective acquisition date, the consideration paid by the parent are based on the fair value of a subsidiary as a whole. The fair value of the subsidiary as a whole. Okay, the fair value of subsidiary as a whole. Okay. So require NCI based on proportionate shares, NCI at the fair value. Okay, so we look at the structure first. Okay, the structures here. A, you need to draw this diagram when you answer the question for this chapters. Okay, we start here. A has 60% over B, and then B have another 75% in C. So indirectly, A have a control over C of 45%. Yeah. Okay, so this is what you have, 45%. Okay. And then for NCI, NCI have 40%. So 40% indirectly time with 75%. So you're going to have 30%. Yeah? For this one indirect, 30%, 30%. And then in C itself, A have NCI have 25% because B control 75%. So NCI have another 20%. So this 20% here is a direct, direct 20% in C. Okay. So we do slowly and this one, if you have a question, please. Okay, now we're going to measure NCI using net asset. So calculate the goodwill on consolidation. Okay, so goodwill here, we need to calculate two goodwills. The first one is a goodwill for AA and BB. Yeah? AA and B, and then B and C. Yeah? Two goodwills. Yeah? Okay, the COI here is 3 million, NCI here is 3 million times with 4. Where do you get this 3 million here? It's from your, this one is given here. Okay, this one. This one. We record this. 3 million for A to B. B to C here is 2.7. Yeah. Okay, 3 million that we have here. So 3 million COI, 3 million NCI here based on proportionate shares is 1.2. Fair value here is 2 plus 1. 2 plus 1 here is the 2 here is from the shares capital. 2 plus 1. 2 plus 1 is shares capital. And then 1 here is reserve here in B. Yeah? So we have 3. So altogether, goodwill that we have here is 1.2 AA in B. Yeah? Okay, BP and C, the COI is 2.7. This one is from balance sheet. Okay, 2.7. NCI asset is 2.5 times with 25%. So we're going to have 6 to 5. Okay, net identifiable assets here. This one is shares capital, 1.5 here is reserve, 2.5. So we're going to have 8 to 5. Yeah? 8 to 5 for the goodwill. And we're going to the goodwill that should be reflected in the A account. It should be consist of, okay, this one is the whole amount of goodwill because A has a control over B. So they're going to recognize the total amount of goodwill 1.2. But for the portion in the group of B here, the portions of the group in B, B to C here, okay, B to C going to have the goodwill here is 8 to 5, 8 to 5. And then B to C here, if you look at here, so B to C, B has a percentage in C here to B to C here, you're going to have only 60%. 60% here based on your subgroup, your controls over B here, 60% only. So from the total amount of goodwill 8 to 5, parents only entitled 60%. 60% here based on the control in the parents control in here. So the amount of goodwill that parents entitled here is only 495 here. From the 8 to 5, parents only entitled 495 here. This is what you have. The portions of goodwill in the subgroup that belong to NCI was 330. And you get that 330, 40% time with 8 to 5 should be excluded. Should be excluded. As far as A right is concerned, so we need to exclude the 40% 330. This one should be debit. Debit there. So, okay, going to prepare the journal entry. Okay, the journal entry. Okay, so I the cost of investment. Investments that we have here. We start with the lower tier. So the lower tier here, BB to C. Start with the lower tier. Okay, prepare journal entry. Start with the lower tier. So BB to CC. Shares capital 70%, reserve 70%, goodwill so already calculate, and then credit investment for the NCI here 20%. And then this is what you have. The same thing, same as what we have previously. Okay. So this is between B and C. Okay, we prepare from the lower tier, B and C, A and B. This is from the journal entry that we have A and B here. NCI, the amount of NCI here, we have 625 here. The investment, we already eliminate from the first journal entry. 825 here is a goodwill here. The first journal entry also, A and B, A and B and B here. Okay, this is the first consideration here between subgroup of BB and CC. Okay, the subgroup of BB and CC. Yeah. Okay, we finish with this one. Okay, and then we try to for the second one. Okay, the second one is between AA and BB. Yeah. Okay, AA and BB, the same thing. B and A have a 60%, so 60 times with 2, same as this one, would be 1.2. Then credit investment, and then this one is for the NCI. Okay, 40%, 40%, and then you're going to have 1.2. Okay, the last journal entries here, okay, the last journal entries here is to exclude NCI goodwill. Okay, to exclude NCI goodwill here, the NCI goodwill here is 330. To exclude this one, you need to debit NCI statements of financial positions. So debit NCI. Okay, NCI statements of financial position, credit goodwill on consolidations. The last journal entries here is the last one. We need to exclude. The last one is to exclude the NCI in the ultimate parents. Ultimate parents, so we're going to exclude here 40% with 8 to 5 here. Okay, just finish with this one. Okay, to get the two, not indirect, to direct C. No, just delete the word indirect, put it as a direct NCI to exclude goodwill to the this one is the indirect goodwill to the parent, so we need to exclude that goodwill. Okay, so this is a sub consolidation groups accounts here between AA and B. So this is what we have for the journal entry, and then adjustments that we have here for okay, and then this one NCI here 625 330 here is the goodwill that we exclude. 1.2 here is the journal entry that we have for the second journal entry NCI 2. So investment in B 0 here, the goodwill here. Okay, look at here. The goodwill that we have here 825 1.2. Okay, the title for 1.2 is your total amount. 330 is the one that we exclude from the NCI. So the total goodwill here will be 1695 here. This one is 825. The 825 is a subgroup. This one you refer back to slide 24. So this is what you have. Okay, we're not going to continue with this one. So just try to understand this one first, the NCI based on a proportionate shares. Okay, proportionate net asset. So for the next class, we're going to continue with the same example, but this time NCI was measured using fair value. You just try to study on that one. Okay, the difference here, a little bit difference here. NCI measure at fair value here based on the fair value as a whole. So there will be calculation for a goodwill, a little bit difference here. So please study on this one. Make sure that you understand based on the proportionate shares NCI, and then to understand this one also. Look at the NCI at fair value. NCI fair value, you need to recalculate. Or when we still have time, isn't it? Or I said time now. I'm a little bit afraid that you're unable to finish with the topics so that you can answer for the tutorial questions. Okay. So so next class we're going to continue with this one. NCI measure at fair value. Let's try to understand NCI at professional. If you have a questions, we're going to discuss that one again. Okay. So the same thing that we're going to use for the NCIFI value, but this time we need to find the new value because we want to find the goodwill itself, because now we're going to have a goodwill for the NCI. Okay, so any questions that you have? Okay, I'm going to start up to this slide. Yeah? Okay, so for the next class, we're going to continue with slide 26. Yeah? We're going to continue with this one. So any questions that you have here? Okay, do you have any questions here? So many things that you need to know, isn't it, for this chapter? Any questions that you have here? Yes, very complicated, but it takes time to study. You need to study this one. And then please make sure that you don't lose for this chapter. Chapter 3 is very complicated. It takes time to answer one question for chapter 3. Maybe 1 hour for one question. It's very complicated. Okay, please make sure that you understand. If you don't understand, please ask for the next class. Study on this one again. And then, okay, try to study the rest.